Hi, I'm Richard Lim, CEO of Retail Economics. Retail Economics is an independent economics consultancy putting economic analysis, econometric modelling, and really importantly, behavioural economics at the heart of the insight we offer the industry. Retailers and brands are going through a period of immense disruption at the moment. The impact of the pandemic has affected all corners of the industry, from the initial stages in our supply chains to final mile deliveries. It has also really highlighted retailers' over-reliance on single suppliers and single country supply routes for many of the businesses that we work with, forcing them to consider supply diversification and even dual sourcing to ensure the continuity of their supply. We recently conducted some research which found that almost 70% of retailers had conducted a review of their supply chains as a direct result of COVID-19. Conversations with retailers also highlighted that significant work had already been conducted around Brexit planning, so they're in a much better position to deal with the impact of the pandemic. That said, the sudden and severe impact on supply chains forced action, with more than half of the retailers that we spoke to already diversifying their supply chains. Other measures included reducing product ranges, nearshoring, diversifying sourcing countries, onshoring, and even increasing inventories. However, there was a marked difference between food and non-food retailers, with food retailers being much more flexible in terms of being able to switch suppliers and supply sourcing countries. These vulnerabilities have emerged following decades of cost efficiencies being prioritised over flexibility and responsiveness. Supply chain security was thrust into the spotlight as retailers faced challenges with procuring the products that they needed. After an initial panic period, retailers began to ask themselves questions of how to design and rebuild smarter, stronger, and more diverse supply chains. As retailers look to build back better, sustainability will play a crucial role. The crisis has highlighted numerous compelling ESG scenarios that cannot be ignored as economies look to rebuild. This will influence the future of international supply chains. There will be many moving parts, but it's likely to include many factors like onshoring, reshoring, nearshoring. There will be regulatory incentives. ESG targets will need more transparency, and also consumer behaviour will also drive change. Firstly, onshoring, nearshoring, reshoring, they've all become hotly debated topics in recent years. Around 22% of global greenhouse gas emissions are attributable to the production and distribution of traded goods consumed abroad, around a third of which are directly linked to trade-related freight transport. Shortening supply chains will avoid some of the carbon emissions embedded in the international transport of goods, encouraging businesses to move supply chains closer to home, while a more carbon efficient local production base will also represent obvious benefits. Our research shows that since the pandemic, 23% of European retailers that we surveyed have switched supply chains nearer to their domestic economies, and 46% plan to do more of that in the future. 14% have already switched more of their supply to domestic economies, and a staggering 42% are planning to do more onshoring in the future. Leveraging these insights, we estimate that over the next 12 months, UK retailers could source an additional $5.5 billion worth of retail products back into the UK. This is roughly the equivalent of the size of the apparel manufacturing sector within the UK. It would be a significant boost to the economy in both jobs and economic contribution. While the appetite for onshoring is healthy across the retailers that we spoke to, there was a clear message that higher costs and lack of supply were two main barriers. The pace of the move to onshoring would be driven by efficiency, and the concerns were if it was done too quickly, then a significant near-term pressure could arise, causing inefficiencies. The companies that relied on human labour to ramp up production in such a short time frame could actually end up building inefficient supply chains, and without care, this could damage their market share and even increase prices. But the potential for reducing carbon emissions is not always clear-cut. For example, more carbon producing transport methods like road and rail compared to ocean freight decouple a straightforward relationship between distance and carbon emissions. Factors like the speed of freight is also really important to consider. Reducing the speed of ocean freight but increasing the time in transport can yield to significant carbon reduction. Our research also demonstrates that strategies to improve supply chain resilience will not be applied in equal measure across all parts of the retail sector. Tailored solutions will be formulated depending on factors like the location of retailers, product type, complexity, seasonality, production costs, logistics, and many other factors. Therefore, supply chain strategies will vary widely across sector, country, individual retailers, and occur at varying speeds as well. The commercial viability of sourcing strategies will ultimately drive the decision-making across firms, but there is a clear desire from retailers to source more locally where the economics allows. For example, it would be unrealistic to assume that a significant proportion of production of electrical goods, for example, TVs, smartphones, fridges, could be onshored into the UK due to restrictions on scale and cost implications. Labour constitutes a significant proportion of production costs, and with higher wages in Europe and significant investment that would need to be made in infrastructure, it would not be a plausible scenario. However, where profit margins allow, parts of the retail sector such as high-end fashion, homewares and food, where there's already a high proportion that's domestically sourced, the prospects of more domestic sourcing is plausible. But some parts of the market have been disproportionately affected by the impact of the pandemic, with retailers remaining in survival mode in some parts of the sector, cutting costs, preserving working capital to weather the storm as effectively as they can. For these businesses, their operational flexibility will be restricted by these commercial realities, giving them fewer options to reshape supply chains. Incentives to build back green will also prove really powerful, with the EU playing a major role in the economic recovery following the pandemic. In addition to a 7-year €1.1 trillion budget, the EU is poised to agree an additional fund of around €750 billion in the form of grants and low-cost loans to support the EU economy as it recovers from the effects of COVID-19. This additional €750 billion, which is being coined the Next Generation EU Fund, will allow the European Commission to borrow directly from financial markets for the first time. The ambition being to herald this as a green stimulus package within the COVID-19 response, aligning the EC's commitment to a sustainability and green agenda. Conditions have been placed on the distribution of these funds, which rely on governments and companies' ambitions to forward the green and digital transition. As the EU plans to inject significant amounts of money into countries and companies, the strong incentive will be for recipients to deploy capital and sustainable projects, and this will be paramount to protect the European Green New Deal. All of these have clear implications on retail supply chains. Of course, the UK would not benefit from this support given its departure from the EU, and the UK has yet to publish details on the future state aid programmes. And although it has hinted towards flexibility in the terms of support range of economic incentives, it may not be possible under existing EU state aid rules. Other regulatory incentives, including a carbon border adjustment mechanism, will allow producers in the EU to meet tough and expensive sustainability requirements, particularly carbon reduction targets, without suffering cost disadvantages relative to importers. Large retail exporting countries like Spain, Italy, France and Germany, being part of the EU, are close to adopting these new rules, which would allow them to apply additional duties to imports of products outside of the EU that have price advantages due to the lower environmental standards because they're cheaper to comply with. This will further incentivise nearshoring and onshoring for many manufacturers and retail brands residing in the EU. ESG-focused investors will also put further pressure on European retail boards to deliver a compelling sustainability story for investors. This will create greater visibility around ESG goals, driving greater transparency around demonstrating tangible metrics and ratings based on their action. Currently, corporate disclosures remain pretty vague. They lack comparability and depth, and they're often infrequent. But as investors demand more visibility and the terms of corporate finance increasingly hinge on the outcome of investors and their ESG analysis, retailers will be pressured to pursue actionable outcomes to reduce carbon emissions, amongst other goals. The influence of ESG rating providers like MSCI have risen significantly in recent years, dovetailing with a huge demand for sustainable investment from large pension funds and retail investors looking to invest in products that do good as well as generate returns. More than 360 new ESG-focused funds were launched in 2019. This was up 2.5 times on the previous year and generated 120 billion euros worth of investment. These underlying trends will sharpen the dialogue between borrowers and investors, which will become more dominated by ESG, and supply chains will play a critical role in this. Retailers are already reviewing how they source products as a critical enabler to satisfy these ESG goals. Our research showed that 70% of retailers that we surveyed have already changed the way that they source products to help meet their ESG goals. The remaining 30% plan to do so in the future. Part of these plans also incorporates onshoring, with 46% of retailers that we spoke to in some recent research claiming that they already source more from domestic economies to help meet their ESG targets. 39% suggest that they plan to do more so in the future to support these ambitions. Consumer pressure for sustainable consumption and production of products has already become a critical issue, influencing where and how consumers shop. More than ever before, consumer awareness and their expectations for more responsible and ethical practices from retail brands are driving business change. Several retailers that we interviewed suggested that sustainable behaviour appears to be influencing consumer choice. Whether it's the environmental impact of textile production, food, furniture, energy consumption, water use, packaging, waste provenance, chemicals, or greenhouse emissions, they all make a difference in consumer choice. Our research shows that Italian consumers, for example, are almost twice as likely to suggest that a product's origin has no bearing on their purchasing decision compared with almost every other European country that we surveyed. Sizable differences also arise in consumers' willingness to pay for goods sourced more locally. More than half of Swiss and German consumers agree that they would pay more, compared with around a third for consumers in the UK. So in conclusion, international supply chain networks are transitioning through a period of intense change, affected by significant interconnected forces. The impact of COVID-19 has acted as a catalyst for businesses to review and prioritise strategies around building more resilient supply chains that are fit for purpose in context of this increasingly volatile geopolitical environment and pressures around ESG. Many retail businesses should see this as an opportunity to reset their thinking around supply chains. For some, the immediate pressure will be on protecting the viability of their businesses, but further out, more strategic decisions will be required to future-proof their operations for long-term success. In particular, it will be imperative for businesses to adopt a digital-first approach in their supply chains, and this will become increasingly more important. It will become the norm for intelligent retailers to quickly identify bottlenecks in their supply chains and pivot towards alternative suppliers to ensure continuity of supply. However, what this will require is that these old, antiquated paper-based systems are replaced with digital supply chains that drive greater transparency, that are faster, and they also give the ability for firms to make data-driven decisions. COVID-19 will also accelerate the IoT hardware, which links the digital and physical worlds. Leveraging data science and analytics will bring real-time visibility across the entire supply chain, and this will bring about greater precision and efficiency. Providing a detailed view of stock, sales, orders, deliveries and returns across all channels will enable more accurate demand forecasting, better inventory sales management, and also deliver really important cost savings. Digital transformation will also be more pressing at the final stages of the supply chain, as this relentless shift towards online shopping becomes a key feature within the industry. Investment in appropriate levels of automated distribution centres and micro-fulfillment hubs to meet this shift towards online shopping will become essential for many retailers that will be pivoting their business model towards a more digital-first approach. Final mile deliveries and efficient handling of returns will also become critical for the industry as they grapple with rising costs and lower margins. Retail brands will also have to adapt to a new customer journey, which will put digital at its heart, from the awareness of products on social media to the tracking of deliveries and organising returns. Providing a single customer view across multiple digital and physical touchpoints and across a more complex customer journey will deliver rich rewards. Companies will have to quickly pivot their business models to adapt to a new set of customer expectations, which will rely heavily on digital technologies. It will also become critical for retailers to lead on ESG and develop credible, realistic, and measurable commitments to address sustainability and their wider societal responsibilities. Retail brands will come under increasing pressure to disclose more data on their carbon emissions and the impact of their sourcing, supply chains, labour practices, waste, and many other factors. A greater level of transparency and depth of data will be used to provide context, and this will be vital for investors to identify opportunities and risks across businesses' entire value chain. A greater level of transparency and depth of data will be used to provide context, and it will be a vital source of information for investors to identify opportunities and risk across a business's entire value chain. The current dearth of corporate disclosures will create future challenges as corporate finance increasingly hinges on the outcome of investors' ESG analysis. This comes at a time when the appetite for ESG-focused investments continues to rise. Lastly, sustainability investment strategies will increasingly incorporate not just what companies do as their core business activity, but how they do it. As the pool for green investment rapidly grows, it presents a significant opportunity for retail brands to lead on ESG standards.